went up sharply, and many others. The market open coming up. The first rates on your screen, 22,720 is where the Nifty is starting at. 74,912 is where the Sensex is starting at as well. So this is a 50-point higher start and a 50-point higher start in the Nifty Bank as well. So this is pretty similar to what we had yesterday, by the way. Bank Nifty is up 1/3%. The mid-cap index is up 1/3%, and I think the small-cap index starts a little higher as well. But it's all about stocks. Sonia has got those. Sonia.
Well, thanks a lot for that. So there are plenty of stocks to look at, right? I thought let me start off with the metal names because that's where all the action has been in the last couple of days. First up, we have Vedanta, right? So CLSA has upgraded Vedanta to a buy from an underperform. Look at that, 3% up move on Vedanta this morning. The target has been increased, by the way, to 390 from 260. So there's a big target price upgrade that CLSA has done this morning. Alchem Labs is in focus. Nomura came out with a note where they say that the observations on the Buddy unit are a bit concerning, and that's why despite the market rallying quite a bit, Alchem Labs is still under a bit of pressure, down almost 0.3%. TCS coming out with numbers on Friday. Ahead of that, the stock has been very lackluster. So the stock is down almost 4% in the last 1 month. And that muted performance continues as we head into the earnings as well. Paytm BofA Securities has resumed coverage on the stock with an underperform rating. They have a target price of 400. So the stock is down almost about 2.5%. Bharti Antique has initiated coverage on Bharti with a 1,500 rupee target price. That's well above where the current market price is and, up almost about 1%. Protean eGov, by the way, 4% equity has changed hands. So just keep an eye out on Protean eGov. That stock is up almost about 1%, I think, right now, trending around that 1,140 mark. But apart from that, the market is not bad at all. 60 points higher on the Nifty, hanging on to 22,700 with so much ease this morning. And, the Nifty Bank is not participating today. So let's see whether that traction picks up through the course of the day. But for now, the market opening is pretty strong. Back to you guys.
Well, metals are doing well yet again. I think the Nifty Metal Index is up close to 1%. So yet again, that's the best performing index. And it's not just Vedanta. The top two Nifty gainers are commodity names, Tata Steel and Hindalco, with a rally of close to about 1.5%. Outside of that, you've got SAIL, which is rallying close to about 2%. And Vedanta, of course, posted CLSA upgrade, has gained nearly 4%. So metals are ruling the roost. Reliance Industries, which was a drag yesterday, Reliance Industries has bounced back, and that's a stock which is up nearly 1%. On the way down, Divi's Laboratory is subdued. That's the top Nifty loser, 1.25% gone on that. HDFC Bank, it underperformed the rest of the private sector financials yesterday, and today also HDFC Bank is under pressure. The cut is not huge. It's down close to about 0.5%. So that's the large cap action. In the mid-cap universe, you've got Sterlite Tech reversing some of yesterday's 13% up move post the QIP announcement. Vodafone Idea is weak. Indus Stars 2 retreats a bit after 60% rally on a year-to-date basis. XI2 has cooled off. And on the way up, you've got a Pesalo Digital, 5% up on that, and GMDC, BHEL, Zomato.
Yeah, no, absolutely. Look at Policy Bazaar. There's PB Fintech. News came yesterday towards closing the last hour. And we put that out, by the way. So ICICI Lombard, the largest general insurer, which was not available on the PB Fintech platform, is now part of the PB Fintech platform. It'll be available on the PB Fintech. You can buy all those policies on the platform. So PB Fintech is seeing a large 5% move. It's the largest volume. It is one of the largest, not the largest, but one of the largest volume-led gainers this morning coming through. Look at Indigo, right? Indigo, of course, is, I think, pretty much at a new high. Fares are going up. There is a player in the market which, of course, has had recent troubles. I'm talking about Vistara. And, of course, Indigo is going in and adding capacity as well. So just a few other names. Shah Metallic, we just had the company with us, 4.5% higher there, 647. That sort of, expansion in the stainless steel side, entry in the stainless steel flat product side, really. HEG is up about 1.5%. Colte Patil is up 4% this morning. There is Sona Comstar, which is up about 3% or so. So it's a, pretty vibrant screen. 2:1 in favor of advances to declines is what we have. I think Rima did mention Indus Tower, right? Indus Tower is down 2, and there's a call there as well. IRB, we'll be speaking with the management. IRB is down 4% this morning, and it's got volumes as well. And IIFL, which had rallied about 25% last 3 or 4 days, that's pulling back just a little bit, 2.25% or so. this morning. Sonia.
So, on Kolte Patil, right, you mentioned Motilal Oswal has actually initiated coverage on that stock. They say that the growth potential is now getting unlocked and they have a target price of 700, which is almost a 35% upside to the current market price.
Yeah.
Now, the big thing that they talk about is not only is the performance picking up quite a bit because Kolte Patil is increasing their presence now in the Mumbai metropolitan region, the MMR region and the Bengaluru market, which are high growth areas. But there's also a very healthy balance sheet that Kolte Patil is sitting on, and that's the reason for which they are very bullish on the stock. Stock is up almost 3.5% today. But if you look at, the last 7 days, the stock is up almost about 12% So, real estate continues to be the flavor of the moment now.
No, absolutely. And that's absolutely right. Yesterday, of course, Godrej Properties saw a big move. We should actually look at Godrej Properties as well and see what's happening there. So many other names are starting to participate as well. Market, breadth is, of course, positive, but it's too early. It was 2:1, but it's slipping. 1,050 stocks are higher, and you got about 900 stocks which are lower. So, the what started as a very strong one-way kind of a move is moderating a little bit at this point in time. Vedanta was at about 355. It's come off to about 351. BHEL is another one into the mix, right? Which is it's up at about 260, 2% higher. GMDC is another one. Look at GMDC, which is up about 4% or so. Very large volumes. BEML is another one. We had a defense company with us in the morning, Paras Defense, but of course these are the larger ones. BEML is up about 2% or so as well. So, lots happening. Well, we'll come back to more names in a bit. The Nifty is up about 50 points, so can't complain. Gautam Dugar is with us, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, good morning. Good to have you with us here. Thank you very much for your time. We are, of course, at the cusp of another earnings season. And I was reading the story on, it was a money control story, and that kind of aggregated earnings expectations from, you guys, Motilal, and a bunch of others as well. And what they're pointing out too is that earnings growth expectations for this quarter are perhaps one of the lowest that we've had over the last 1 year or so. We've kind of seen some earnings cuts, etc., going into the earnings season as well. Just wanted you to contextualize that. Are we starting to see a deceleration in earnings growth, or is it something else? Go on, Gautam.
Hi, Prashant. Good morning. So two different points there. First of all, you have to look at the context of what happened in the first 9 months. The first 9 months earnings growth in Nifty was 26%. And we had expected sub 10% kind of a growth in fourth quarter because we had done the 4-quarter split right at the beginning of April, as we always do last year. So this quarter, 6% growth, therefore looks a bit softer. But you have to look at the nuances behind that. Number one, it's being dragged down by commodities, which is metals and oil and gas. So for my coverage, if you remove these two sectors, the growth is about 12%, right? If you look at the similar number for Nifty without commodities, the growth is about 9-10%. So yes, versus the first 9 months, it looks a bit soft. But also remember that for the full year, you are ending at 21% earnings growth, EPS growth for Nifty. Next year, we are expecting about 14-15% kind of an earnings growth number. So there's 980 rupees of EPS that we are building in for FY24, which has been pretty stable, by the way. There's been no cut for the last 7-8 months now. We were around similar 974 number in October 23, and now we are at 980 rupees. So broadly stable for FY24. FY25, we are down from 1130 to somewhere close to 1120. So marginal 1% cut. Now, if you do 14-15% growth even next year, then this will be the first time after a long time that for 5 years in a row, you're talking about a double-digit earnings growth. Because last 4 years, between FY20 to FY24, Nifty earnings have already compounded at 22%, from 3.4 odd lakh crores to somewhere about 7.8 lakh crores. And if you look at a broader market and look at our coverage universe of 270 stocks, we are talking about a compounding of 27% between FY20 to 24, right? From about 4.3 lakh crores to about 11 lakh crores this year. And our expectations for next 2 years for our coverage universe, the broader universe, is about 16% compounding for next 2 years, from 11 lakh crores to somewhere close to 15 lakh crores. So I would say, quarterly fluctuations aside, the earnings momentum for corporate India is very solid. And like we have mentioned in our report, it almost feels like a mini Goldilocks because macros are fine, earnings growth is fine. So yes, this quarter is a bit soft because of commodity, but otherwise the trend is quite intact.
Okay. Gautam, hi, good morning, and thanks for joining in. I have to ask you your view on what's happening with the rise in gold prices, right? I mean, in so many years of tracking the markets, I've never seen a time where gold is rising like this at a time when equities is also surging. But it also speaks about how the power plays perhaps seeing a tectonic shift away from the west to the east, with China buying so much gold to hedge against the dollar. What does all of this mean for an equity market investor?
So Sonia, it's futile to predict, the commodity prices. This is one thing I've learned in the last 17 years being in markets. Whether it's gold, crude oil, metals, you just cannot predict it. Yes, it is a bit, unprecedented that you are seeing equity markets at a new high. Gold prices are doing well. At the same time, the 10-year yields of US have risen also. And there is a potential discussion on rate cuts timing. So not everything adds up, right? So at some point of time, something has to give away. Now, a job of an investor, especially equity market investor, is to look at investable ideas in investable sectors. You can discuss, where the gold prices are going or where the crude oil prices are going, but the probability of you getting that right is next to zero.
My question, Gautam, my question is more to do with asset allocation, right? A lot of people are having this missed out feeling, left out feeling in this gold rush. So what is your advice to them? Does it make sense to still buy at these levels or just, stick to plain old equities? Because a lot of the buying that you're seeing in gold could also be speculative.
So, Sonia, all I can say is one should have a very diversified asset allocation based on one's risk profile. Unfortunately, my expertise on gold is very limited. Yes, we do like some of the plays on the gold in the listed equity space, which is where we have a very bullish view for last 10, 12 years, part of our model portfolio too. But from an individual's asset allocation perspective, obviously he or she should have some gold in their portfolio. But beyond that, it's going to be very difficult for an equity market guy to comment on that.
Gautam, morning. Rima here. This entire recovery or the continuation of strong earnings growth is also predicated that consumption picks up at some point of time, right? Is that a big risk? Because consumption has been lagging, rural has not picked up as of now. When do you expect consumption to pick up? And will that be a big risk to monitor? And also a little more on commodities, because commodity prices have started going up.
So two things, Rima. First of all, next year's growth is not predicated on consumption picking up. If I give you the numbers, next year's 16% growth, roughly 50 to 65% of, or rather 2/3 of the incremental earnings are coming from three sectors, which is financials, metals, and metals is obviously rebounding from the low base. So it's a bit of an optical element coming into play. And then you have some recovery built in IT, right? So consumption per se, we are not expecting any big up move, at least in staple companies' earnings. In fact, our own estimate for staple earnings next year is somewhere about 8 to 10% earnings growth, which is way lower than what we are building in for the index. When does consumption revive? There are two aspects to look at it. Consumption is a very broad ocean and there are multiple subsegments. Some of them are doing exceedingly well, things like hotels, things like discretionary names and jewelry and all. They're doing phenomenally well. What is lagging, however, is the low ticket consumption item, right? Which is staples, the home and personal care and things like that. Now, for that to recover, there is a requirement of 2-3 things to happen. Number one, the monsoon needs to be normal, which is a good thing because there's a prediction that this year's monsoon is going to be normal. Point number two, inflation needs to come down, which is also happening, by the way. So inflation prints are coming off. And third, this is a hope that the political spending in the forthcoming elections, which at some point of time with a lag of 6-7 months, will propel consumption at the bottom of the pyramid. So if I remember well, 2019 general elections, the total political spending as per various estimates was about 60,000 crores. It's fair to say that this year should be closer to 1 lakh crore. Now that kind of money trickling down will obviously take some time before it reflects in the numbers of consumption companies, but that's a hope. Because this stocks, this volume growth, top line growth have been lagging not just for last 2-3 years. If you look at the last 10 years data of consumer staple companies also, hardly 1 or 2 consumer staple companies have been able to compound their top lines at 10%. Most others have compounded at 6-7%. Top line growth, I'm not even talking about earnings. So top line has been very, very lackluster for almost a decade now. So that's a hope. But from our point of view, we are still very, as far as our model portfolio is concerned, we are completely positioned towards discretionary consumption. So out of the 9 stocks that we hold in model portfolio, 8 are discretionary in nature. There's just one consumer staple company.
Got that. Gautam, just to come back to metals, right? Not asking you to predict prices, impossible to do. And of course, I mean, the old adage, right? Metals are best bought or sold at extremes. Actually, on the selling side, tough to say when it's at an extreme, but easier on the downside. Now, of course, they're not at the lower end in terms of valuations or anything. But just, and I know that I think Hindalco is part of your model portfolio, but I wanted your thoughts on Vedanta here. It's actually 2 names, Vedanta and Hindustan Copper, if you have. I'm sure you've looked at the business. Vedanta, of course, is a play on a variety of commodities, but also it's been going through a fair bit of turbulent phase. Hope, of course, always has been that they're able to sort those issues out. So it'll be able to, and then it'll be able to realize its full value. Just your thoughts, Gautam.
So, Prashant, unfortunately, I will be able to comment on individual stocks now as per the revised disclosure norms. Any which ways, Hindustan Copper, we don't have a coverage. But to make a broader point on metal space, just remember, Prashant, that when we are talking about next year's earnings growth of 35%, our numbers for Nifty metal companies, including Coal India, the profit number is somewhere close to 72,000 crores. This year they will do 53,000 crores. But do remember that this 72,000 crores, if it is achieved in FY25, it will still be 30% lower than what the metal profits were in FY22 when they hit 93,000 crores. So there is some element of, as I said, optical illusion built into it. And there is also a fond hope that the global economy will show some recovery, especially China. Because when you talk about metals, obviously the big elephant in the room is always China. So that is our expectation, that there will be some recovery in metals profitability, and which is why we've raised allocation on metals in our model portfolio from being underweight for last almost 9 months to now being neutral.
Okay, all right. By the way, I think you have Lemon Tree, which is part of your model portfolio as well, right, Gautam? So you may want to hang on and listen to the next conversation which is coming up, which is, of course, the Lemon Tree conversation. The management, I think, is with us, and he's ready so we can go across to him. So they've, of course, crossed the 10,000 room mark. It's also launched the first property in Nepal. To discuss some of this and, of course, their expansion plans beyond India, we have Mr. Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels. Mr. Keswani, good morning. Good to have you with us here. Thanks very much. Things have been going great. So every time we get you on, the first question always is, do things continue to remain as great? Or have you noticed any downshift or even upshift, if it's possible, in that sense? I'm talking about occupancies and average room rates.
Well, the good news is there is no downshift. But, we have now entered H1, which is typically the low season for the hotel industry. And when I can compare it to the previous year, I don't see anything which is less than last year. There is, I think, a slight pickup in demand. But overall, as I think I've said earlier, there is, I think, going to be a structural shift in demand in India for branded hotel rooms. And elements of that, I think we already see playing out. And this will continue for the next 3 to 5 years, in my opinion.
That's interesting. So, Mr. Keswani, hi, good morning. Can you tell us a little more about what this structural shift in demand could be? How is the demand-supply situation right now? Because a lot of segments, say, weddings, for example, right? Prime Minister Modi has indicated that a lot of the weddings now need to happen in India versus happening abroad earlier. So that would, of course, give rise to further demand. So I'm just trying to understand, when you talk about a structural change in demand in the industry, what are you trying to, what are you getting at?
Good morning, Sonia. Well, I think what I'm trying to say is that it has been, typically in our business, we look back and look at the trends and then try and project the future, which is some form of forecasting. So what we are really saying is we know how much supply is coming out in the next, say, 3 to 5 years. We know the trend lines of demand growth based on various parameters, and then we try and project what the likely occupancy and therefore price will be. But when I say structural, what I'm fundamentally saying, and this is not only true for hotels, I think this is true for the overall consumer discretionary story in India. It is that, in the past, about 60% of our personal consumption expenditure was always going towards staples. But when you go forward and, as the economy grows, that percentage will keep reducing because there is, you consume staples and that's that. Beyond that, as your income grows, and there are increasing cohorts of Indian consumers who are now moving into a position where every year with the growth of say 6, 7, 8% in the Indian GDP, there will be maybe 8 to 10% of Indians who move into an inflection point where their incomes are such that they spend much more on what earlier was discretionary for them. So they start basically moving from discretionary to non-discretionary. And that is what I talk about. So that is no longer looking back and saying every year this sector, this segment grew at 5% or 10%. This is a hockey stick growth because you have a very large number of Indians who will suddenly start, for example, traveling in SUVs on 4-lane highways within 4 hours of urban centers in India and going on holidays. I mean, this is just an example. So that is basically what I'm trying to say. And that typically happens in a country's economy when the GDP per capita, moves from $2,500 to $3,000 per capita.
Got it. So when you talk about a structural uptrend, you're talking more about consumer preferences also changing, and now India moving from, say, a low income to middle income economy. So, spending more on discretionary things. Got that.
Absolutely.
But how are you going to capitalize on all of this? So if you can tell us a little more about your expansion plans. What is the hotel opening pipeline for FY25 and over the next, say, couple of years?
So broadly, I reckon that we will open about 2,000 to 2,500 rooms this financial year. And we will add or put in our pipeline another maybe 3,000 rooms. So overall, the inventory will grow 20-25%. And the pipeline will grow by about 3,000 rooms, which is about 30%. So basically, our intention is every year we add more rooms to our pipeline than the number of rooms we open.
Does the political calendar or the IPL boost demand just in the near term?
Yes, in some cities it boosts demand wherever events like this happen. And as far as the elections go, obviously there is more travel, but conversely also less demand in some ways. So I think it balances out.
There will be no perceptible improvement in demand due to elections or IPL in Q1?
No, that's not structural. That is event-based. But
yes, event-based, but just in the near term.
Yeah. So there will be some improvement, but in some cases, because of, all these rallies and so on and so forth, people will also not want to travel to a city. So I think on the balance, it evens out.
Aurika in Mumbai, what's been the occupancy?
Well, that is, I'm in a blackout period, so I don't want to comment on the occupancy. But overall, I can say it is in line with what guidance I've given, that the demand is quite good.
Absolutely. Mr. Keswani, if I can request you to take a question from Gautam Duggar, who's been listening by. He's head of research at Motilal Oswal, tracks the company, and stock is part of the model portfolio. I'm sure you know him well. Gautam, go ahead.
Thanks, Prashant. Just wanted to understand, Mr. Keswani, good morning. Do you see the cycle extending? I don't want to basically ask about specifics of the company, but hotels as a sector has done exceedingly well post-COVID, right? Whether you or your peers. And we are seeing some of the subsectors in consumption, something like a real estate or other discretionary consumption sectors. The cycle is prolonging this time, and this has not happened in the past. Margins have gone up, occupancies have gone up, and demand is outpacing the supply CAGR. How long do you think this can last? Is it a 2-year, 1 year? Just some perspective on that would be very helpful.
So, good morning, brother. Typically, we do look at the hotel industry, all of us, as a cyclical business. And therefore, we say how much is demand growth? And, looking back, what was normal demand growth linked to a certain rate of growth of economy? What is the supply growth, which is known because it takes a few years to build a hotel? And then we try and project occupancies. But the broad point I'm trying to make is that if you look 15 years ago or 16 years ago to, say, Indonesia, and a year or two before that to China, and then go back to other countries that were roughly at this point of GDP per capita, as is in India, there is a magic number. The magic number was $7,000 per capita, which means roughly $35,000 per household. At that point, there was a huge change in demand for branded hotel rooms. And if I look at China or Indonesia, say 2006 to 2013, the annual rate of growth of demand for branded hotel rooms was CAGRing at over 22, if I remember right, 22%, as opposed to earlier years when it was less than half of that. Broadly, this is when, and I'm sure you understand this, very well, that there was a very large number of consumers who suddenly started consuming branded hotels. And therefore, the looking back of trend lines and linking it to growth per person and GDP and so on was no longer valid. So it was like a hockey stick for that 5-year period. And then again, it stabilized and started growing at 7, 8, 10% a year. So what I'm trying to say really is that we are on that runway. Now, whether it happens, in 1, 2, or 3 years, I cannot say, but I'm 100% sure it will happen in the next 4 years.
Okay. It's interesting that we're having this discussion because the other thing that is, India is benefiting from, Mr. Keswani, and I'm sure Gautam, you would agree as well, is this huge demographic dividend that we're sitting on, right? I mean, India has about, 600 million people who are in the age group of 18 to 35. And I think one of the youngest population in the world. So, and at a time when now the younger generation prefers to spend on experiences rather than things, Mr. Keswani, do you think that is an added incentive? Is that something that you guys have already priced into your, say, average room rate predictions, for example? I mean, do you think that there could be a disproportionate rise in some of these metrics purely because of the demographic dividend?
So it's a very interesting point you're raising, Sonia. So let me just give you, for the hotel sector or the tourism sector, what I would call 4 high-frequency indicators of demand growth. One is the number of runways in India. So right now we have, I think, roughly 150 airports with a certain number of runways. I believe this 150 is going to go to 250 in the next 4 to 5 years. That is what the government has announced. Number 2 is that the number of seats or airplane seats in India is poised to grow from current to 2.5 to 3 times this in the next 4 years. The number of 4-lane highways in India have grown 3x in the last 4 years and is continuing to grow at that rate. The rate of growth of demand for SUVs today, that's a magic point, by the way, is already 50% of total demand for passenger cars. So when you look at all these, what does it tell you? It tells you that there will be far more growth in travel, both by car and by air. Number 2, you link that to the fact that, as you mentioned, demographic dividend, the new younger Indian is far more aspirational, driven by credit. So my guess is that one big sector that will grow enormously in the next 5 years will be the industry that provides credit to young Indians with good credit management, because they spend today and pay later. They are aspirational, they are brand driven, they are experiential. They are typically under 30, 35. We see that in our own hotels. So you just put all these, try and connect all these dots. And the broad point, which I think we have all kind of agreed on, is that there will be no longer 6, 7, 8% growth in demand, but for maybe the next 5 years, starting maybe this year or next year, that demand growth will structurally shift towards, say, 15, 20% a year.
For a couple of years and that too. Mr. Keswani, fantastic conversation, sir. So interesting when you sometimes pull back from the quarter-on-quarter numbers and look at the bigger picture. You get and very good data points on the airports and the capacity which essentially is going to come up over the next couple of years as well. Thank you for joining us and good luck. Hope to speak with you after the fourth quarter numbers. Gautam, if you're there, thank you very much for asking that question and staying on as well. Thanks indeed. We'll take a quick commercial break here. We'll come back and we have the management of IRB Infrastructure. We discuss the news this morning, of course, apart from the business updates as they've come through. Stay with us. We'll also, after that, be joined by Devina Mehra, First Global, and we discuss all things markets, macros. So that's going to be an interesting one as well. Stay with us.
Well, IRB Infrastructure is the next management on the show. The company's toll collections rose 30% to almost 481 crores in March. Also, in the IRBAV tollway versus the NHAI case, the arbitral tribunal has ruled against the company. To discuss more on this, we have Tushar Kavedia, who's the Group CFO of IRB Infrastructure, who joins us now to talk about that. Tushar, thanks a lot for joining us. First, I want to ask you a little bit about the toll collection, right? Can you give us an update on that? Year on year, what is the growth that we're looking at in FY25? What's your prediction? And also, there are some reports on toll stoppages because of some unrest. Have any of your collections been impacted because of this? If yes, what's the update there?
Yeah, sure. Thank you. And good morning to all. So if you see our performance for FY24 on the toll collections, where we have seen a good, robust growth month on month, and the year by ended with almost 24% annual growth from a group perspective, which includes the private InvIT asset as well. And for the month of March, it was almost 30% growth on a YOY basis. Looking to this performance and adding of the new assets which are from the NHI side, that is TOT 12 and 13, which commenced its operations from the April 1. These two assets will start contributing to the toll collections in the next year. And looking to the past performance on the toll collection, we expect a good robust growth for the FY25 as well. And as such, we have seen that the GDP expected for next year is around 7%. So which leads to a traffic growth for us, and corresponding there will be a tariff hike with link to inflation, which we expect around 4 to 4.5%. So considering both the parameters, the growth is expected around 10 to 11% of the for the next year, FY25. Now coming to the obstacles, we have not seen any obstacles in our collections. The collections are going fine across all projects. There is no hindrance on the toll collections, and they are operating very smoothly. One thing I want to update on our performance for the last year, that this whole year FY24 was remarkable for us, considering be it toll collections, be it acquisition of new assets. We were able to acquire a couple of TOT assets, which bring us to the largest TOT share in the country with 37%. We have
Tushar, we'll get to individually each of these in just a bit from now. Good morning, Prashant here. And great performance, really. Could you, but if I can sort of ask you to comment on this, the long pending case in terms of the traffic diversion at AV Tollway. Is that a bit of a setback? Can you sort of contextualize that for us?
Yeah, sure. So if you see, we have got the arbitral award yesterday only, and we were also being saddened with the award. So looking to the award, if you see, our claim was with respect to the competing facility to the particular stretch, and which was the claim was filed for from the year 2015-16, when we have seen this competing facility has come up. parallel to our stretch. Now, if you see the arbitral award, the award has already has considered this competing facility, but the year which they have considered is 2019 instead of 2015. So looking to our claim, which was relating to 2015-16, the timelines is something which is now the basis of contention in the court of law, where the claim is already being
What was the Tushar? What was the size of the what was the amount under dispute?
So amount of dispute, when we say that amount of dispute was due to the competing facility, say around from 2015-16, it was close to 1,000 crores, but it is a continuous claim which will exist for every year, because this facility is already treated as a competing facility even by the arbitral tribunal. Now,
No, so this is, you said 1,000 crores or 2,000 crores. I missed that number.
No, 1,032 crores, which was since 2015-16, which was filed in as a claim in our in the arbitration claim itself, and which was for a particular period. Now, this is a continuous claim which will be for a year-on-year basis, and looking to the order as such, the arbitral tribunal has already agreed that there is a competing facility, but due to technical difficulties, since the compensation compensation documents were not available, the computation document were not available, the award was without considering
Denied.
that aspect and denied, and this leads us to a strong case, a prima facie strong case to challenge in the High Court, where we will put forward our case basis our computations for the claim, considering this as a competing facility.
So you will be filing a counterclaim in the higher courts, and you're hopeful that you will be granted that compensation of 1,032 crore. What's the timeline for that?
So again, we have the legal remedy available. With all the advice of our legal counsel, we will take this forward, and we will, in due course, we will be taking this in the courts as well.
What is your current order book? We have the update as of December 31st. Moving on to business now, 36,200 approximately. What does the number stand at? And what is now the executable order book over the next 2 years?
So if you see our order book with addition of this new TOT stands at 36,000 crores, and the executable order books for next 1.5 to 2 years is around 10,000 crores, which includes an EPC order book of 7,000 crores and balance towards the O&M order book of the projects under the operations.
And your L1 orders, what does that stand at?
We are just waiting. There's a good pipeline from NHA available on the BOT space, where we have a lot of expertise, and we are the largest in that particular space. There's an ample opportunity coming from NHA side, and 2 trillion of assets worth of assets is expected to come for bidding in next 1.5 to 2 years, and we are quite confident to get couple of them with the added advantage of having partners like GIC and Centra, and also the healthy balance sheet what we have today after deleveraging ourselves. So that leads us a more competitive edge compared to others, and we will be more benefited with this strong balance sheet going forward for new biddings as well.
But Tushar, the awarding by the NHAI has been a bit muted, right, in FY24 at least. How much has it been so far? And what is the BOT projects that will be coming up for bidding?
So as of now, if you see, due to the code of conduct, the bidding was slightly slowed down. But if you see, they have already shortly listed the assets which are going to come for bidding. We expect in few months these assets will come up for bidding. Out of this 2 trillion, we have seen 30,000 worth of assets are already had come for bidding, and the balance will come in a phased manner, which we believe should be there in 1.5 to 2 years of time.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Yeah, go ahead.
Yeah. With respect to the claim, the arbitration claim, I just want to point out one more thing, that the project is doing good, and it has shown almost 12% kind of revenue growth in last 2 to 3 years. And considering that aspect, going forward, we should be comfortably meeting our debt obligation. In fact, the premium obligation in the balance concession period, which is expected around 20 years from now. And if at all, if you see the valuation of this particular asset in our whole valuation of IRB is quite minuscule and non-significant, because what we have seen, the analysts are just giving a weightage of around -1 to rupees 3 for this particular asset, and without factoring any arbitration award in this case. So as such, we don't see any impact of this order as such on our valuation.
Just one quick question. Can you take us through the entire process of the secondary stake sale that happened in the private InvIT? How were the valuations arrived at? And what does the entry of Ferrovial mean for InvIT prospects? Does funding become easier? And will you look to aggressively target more?
Yeah, so if you see the confidence of our investors, which include the strategic investor like Sintra, that continued, and we have seen this deal happening at the private InvIT level, where they are acquiring the stake from GIC of 24%. And with the valuation, what they are paying, there's a price is 67 billion for the acquisition of 24%. What we have seen, the valuation, just doing the maths, it's like for the 10 assets which were part of, which were operational, it was almost 2.5 times to the book. And with that kind of valuation or the fair deal, we see that the total valuation considering all assets would be somewhere around 400 to 480 billion. And looking to that size of valuation, where IRB owns 51%, it gives a fair value for the IRB stake as well. So this platform itself has been valued by the strategic investor, and they want to participate in the growth platform where the value was created since the time it has been created last 3-4 years back.
All right, we leave it at that. Thanks a lot for joining in and all the best. That's IRB Infra. By the way, the market is picking up pace, not so much the headline index, but I think there's a lot of action in the mid-cap end of trade. The mid-cap index is now up almost 300 points, and it just goes to show that this is such a momentum-driven market. There's so much money that has been flowing in from the domestic fraternity. Now, FIs have started to participate as well, and the going is only getting better. In fact, Devina Mehra is joining in. She's the founder, chairperson, and MD at First Global, and she's joining in to discuss her view on the market. Devina, always great speaking to you, and you know, good to know that you are in Mumbai. You're in Mumbai right now, right?
Yeah, I'm in India.
Okay, you're in India. So good to see that, and hope you have a good stay here. But, you know, it's been a great run for this market. Not just Indian markets, global markets are doing well. Commodities like gold are doing well. How are you feeling about, you know, the global market situation right now? And what's the best way to approach it for the rest of the calendar year?
So I am quite positive on the global market, especially the equity side. So that remains, that has been my stance for a while. And besides, you know, everybody only looks at US, so that obviously looks fine. And but the good thing has been that unlike 2023, where for the first 10 months, there was only one thing which moved, which was the 7 mega tech stocks. And that was actually a worrisome time, because the S&P moved, let alone the NASDAQ, 90% of it was just 7 stocks. But from November onwards, that has broadened quite a lot, and which is a good thing. And some of those magnificent 7, as they are called, have fallen behind. Tesla, I was reading just a couple of days back that it was the worst performing. It has been the worst performing stock so far in the S&P this year. Of course, it rallied a bit since then. But so as I always say, the themes change, the leadership changes, but there are always opportunities. And one market which we have been overweight on from, I think, about a year ago has been Japan. India also, in our global funds, we are somewhat overweight. China, we've been waiting for a bottoming out, but that bottoming out hasn't happened yet. So yeah, there are a lot of things where you can, there are a lot of opportunities, and equity markets in general look fine from a medium-term perspective.
So Devina, China has not bottomed out. What will be the markers to assess when China bottoms out, and what is your own view on that market? When will it bottom out?
That is difficult. I mean, as I said, we've been watching actually the last 6 months, that it's just as we were watching Japan beginning of last year for a signal, and that signal came around April and we went overweight. But China has been among the major markets the most beaten down one, and people try to kind of correlate things with the economy and say that what happens in China and therefore what will happen in terms of economic terms, and therefore what would happen in the market. But it's not so simple. The very fact that the Chinese market made a high in 2007, and since then the Chinese economy is up 7 times and the market has not taken out its high, it shows you how far the disconnect can go. So you have to watch the market indicators rather than what is happening in the economy.
Devina, hi, morning. Prashant here. Now, where does one get to make money? I know that in the near term, your view is a bit cautious, next 1 to 3 months, right? So one got to protect downsides as well. But what about commodities? Suddenly there's a fair bit of excitement. You know, that old thesis of a big super cycle and metals like copper is making a comeback. It's a thesis, but we'll see where it goes. Oil prices, 90-ish, sort of hovering there. And other commodities have also been doing well. Is that the space where you think one can sort of make incremental money from here? Just talk to us about that, Devina.
Yeah, so in our rebalance, which we carried out just now in the last few days, because we rebalance every quarter, we've added a couple of metal names since you spoke of commodities. But I mean, I am not into these grand narratives of super cycles and so on, because the narratives always follow what is happening in the market. And commodities upticks often don't last very, very long, because that is not beneficial for the majority of the world. But I mean, as of now, as I said, the metals looked good. We've added a couple. As far as the market is concerned, yes, I mean, while I'm cautious about the next 1 to 3 months, that doesn't mean that you should be out of the market, because I always say that there's a risk of being invested in the market, which is a risk of a downside, but there is also a risk of not being invested and missing out of on an up move. And up moves often happen when you least expect them to. So unless there is a possibility, very clear possibility of a big crash, which I don't see, it is better if at all you want to do anything, you can hedge a bit. We were hedged up until now. Those hedges expired. We are just reevaluating how many hedges, how much to hedge now. But we definitely are not making a big cash call, and we plan to be mostly invested. In terms of sectors, I've often spoken about capital goods, industrial metals. So we've been trimming every quarter, but we still remain overweight. Last calendar, from beginning of 2023, we went overweight autos and pharma. We've added in both these spaces in this rebalance also. Will be a little overweight construction. So broadly, that's what we have done. IT is one space I'm watching for bottoming out this year, but again, it's still waiting for the signals for that to happen.
Any early signals? No, not yet.
Yeah, I mean, I expect sometime this year that would happen, but right now we are not overweight.
Chemicals, and that's another global sector, especially agri-chemicals?
I mean, right now our systems have not signaled any big names there. We'll keep a watch. Again, it's a volatile area, and also the chemicals, while we talk of it as a chemical overall segment, often what happens is that something which is good news for one segment of the market is bad news for another segment which uses that product as an input. So chemicals, you have to go into details about every company's product list and what's happening in each of those things. So it's not a sector where I think broad calls work.
Devina, just coming back to the larger theme, right? There is so much talk about de-dollarization right now in the global markets, especially with what's happening with gold. But this is a narrative that has been going on for a while. How are you looking at all of this, and how do you think markets like India could either benefit or fit into the scheme of things if de-dollarization plays out?
I don't think it's going to happen in any meaningful sense. And as you said, these are narratives, which means they are stories, and stories always follow what's happening in the market. And I'll take you back to 2003 to 7 when emerging markets did so well. Emerging market index went up 3.5, 4 times. India went up 6, 7 times. And at that time also you had heard that US is over and this is now going to be the century of India and China. That's when BRICS was coined. But as soon as the outperformance of emerging markets went away, all that story was forgotten. So de-dollarization is not going to happen in a hurry. It has, even over decades, very little of that has happened, either in terms of how much of the trade is built in dollars or in terms of how much of the central bank reserves are held in dollars. And really, if you look at it, what are the alternatives? Euro to an extent is there, which anyway is used, or a little bit of Swiss franc. But still, dollar remains the major currency. And if you're talking about the Indian rupee, for instance, becoming an international currency, I mean, think about it. Who would want to hold Indian currency beyond the point that you are importing from India, which is what happened with Russia rupee trade, that beyond a point Russia said, what are we going to do with the rupees? China has a better case simply because they export so much. So, therefore, their currency is acceptable in more places because the countries can use it to import something from China. But on a larger scale, I don't see that happening in a hurry. So this is all stories.
Okay, and why are you not in the camp of a commodity super cycle, Devina?
Again, see, this is super cycles are all stories. If you go back and look at the same people who are talking about super cycles, when had they said it last and what happened? So normally that doesn't, commodities, as I said, hurt a lot more people than they benefit. So commodity bull markets are typically something people don't like, unlike most other bull markets, and therefore difficult to sustain. And so, I mean, stories can be formed anytime, but I don't see that like it happens for a period of time. I'm not saying it will, the commodity prices may not go up for a period of time. I told you we've added metals, but I don't believe in these like 10-year cycles of commodities.
Devina, by that same token, would you agree that this entire narrative, and I would call it a story as well, that China is going to disappear as a viable market for investment managers and ex-China funds, etc., will be the new thing. You think that's also a passing fad?
Sorry, I missed the first part. What would disappear?
We're talking about stories, right? We're talking about stories and how they really play out. Sometimes they do, but for short periods, as you said. This narrative, right? China +1, and then take China out of the equation, and the ex-China, EM ex-China funds. Do you think that is also kind of a passing fad, a story which China perhaps is just too big to ignore in that sense? Briefly, Devina.
Yes, of course, China is a very large market, even on an overall sense, not just of course, it's the largest in the EM. Because it has not been doing well, that is when people say that, just take it out, and that often is closer to the bottom of that market rather than the top. So as with all themes, any kind of thematic funds or schemes come near the peak of the cycle, or in this case, because you're taking out China, you can say it's probably a signal that China is closer to the bottom.
Absolutely, and I think that's an important framework to remember. Thank you very much, Devina. Great to have you with us here. Great chat as always. Appreciate your time here on CNBC-TV18. Thanks indeed. Well, that's Devina Mehra with thoughts on markets, global markets, commodities, the market here, sectors she likes and everything. We'll take a break here. Mitesh will be with us with some technical trading ideas on the other side. So we'll talk about here and now. Nifty's up 40 points. Stay with us.
Welcome back. All eyes are going to be on Zomato, whether it crosses that 200 rupee mark. It's gotten precariously close to that, 198. The high today was 199.6. That's the intraday high on Zomato, 199.6. So will it touch the 200 rupee mark? It's had a fantastic run. Zomato is up 60% in this year itself. Mitesh is now back with us to walk us through the day so far and the way ahead. Mitesh, your 10 a.m. calls.
Yeah. See, I think the day has been quite positive, and the good thing is that the Bank Nifty is trading positive. I think, I expect the strength might remain. And in that sense, yesterday's low for the Bank Nifty becomes our trading stop loss. Having said that, Castrol is something which has been enjoying a good momentum, and today is seeing continuation. So buy here. Keep a stop at 218.5. Look for targets of 240 in the short term. And other one is the mid-cap stock. The breadth is also showing good momentum. So NLC India is on my radar. The breakout happens at 239.5, 239 levels. So I think buy above that with a stop at 230 and look for target of 265.
All right. Thanks a lot for that. Well, let's shift our focus to the commodity markets where all the action is really for the last many days and weeks. So Manisha has her hands full. Manisha, what's the one commodity you're tracking today?
Well, it's difficult to do that really, Sonia. So while gold and silver are trading at an all-time highs in the Indian markets and the international markets as well. But I do want to talk about industrial metals right now because the strong manufacturing activity that we are looking at globally seems to be supporting this. So when you look at the manufacturing numbers from US, China, Germany, all of that has improved quite strongly, and that in turn has been supportive. I want to start talking about zinc first because the latest outperformance has come in from this one. It's trading at a one-year highs right now, and we are trading above $2,700 a ton onto this one. The reason that zinc prices are in support because there are reports of various mine closures in Australia and Ireland as well. In any case, the zinc demand seems to be improving, especially in Europe and China as well. The other metal on your screen clearly should be copper because this is where it all started. LME copper is trading at a 14-month highs. There is a very strong fund buying that we've seen. If you look at the Chinese copper prices, they are trading at an all-time highs. When you look at the US copper prices, well, they are trading at a 16-month highs. So when you look at the global markets across time zones, copper seems to be doing well in each one of them. We also are looking at stronger strength going forward. Also, when you look at LME and Shanghai right now, the gap is the widest since 2013, and there's a lot of arbitrage opportunities and trades that we are seeing happening between both of these exchanges. And this is what the brokerages are now saying. Citi for one sees copper at 9,700 in 3 months and at $10,000 a ton by fourth quarter. Citi also has a report suggesting that $12,000 of an all-time high copper is what you could be looking at in the next year as well. So this is not a short-term rally by any chance or standards that you're seeing in copper. Goldman Sachs also is talking about $10,000 a ton of copper, and they expect that price in this year itself. So very strong going when it comes to copper prices there. Platinum is another one, and the prices are trading at a 4-month highs onto this one. In the last 3 trading sessions, we've seen platinum prices gain up by 12%. So $1,000 an ounce is back in case of platinum. Tin is trading at a 15-month highs. Indonesia has restarted mining, but there are concerns about regulatory approvals going forward, and that is keeping these prices in favor as well. So as I said, everything from copper, zinc, tin, lead, nickel, aluminum is trading in the positive and at multi-month highs. I also want to take you through on what we've done in the previous 1 week when it comes to many of these metals. So copper is gained up by 3.5%, but copper has been gaining for last 5 weeks now. Aluminum, similar story, 1.5% up in this week as well. Tin has surged up recently, so 7% of gains onto this one in a matter of a week. And when you look at the other metals, zinc is up 7.5%, lead 7%, nickel 7.5%, and all of this movement in these prices has happened over the last 6 or 7 trading sessions itself.
All right, Manisha, thanks very much for that. So commodities really, seeing a lot of move across the board. We'll take a quick commercial break here. We've got another very interesting chat coming up, right? Water, that's the next big problem over the next many decades, and how to solve for that. So we have Rajiv Mittal, Managing Director and CEO at Viatech Vabag, joining us, and we also have one of the foremost infrastructure analysts, Vinayak Chatterjee, founder and managing trustee of the InfraVision Foundation. We talk about what can be done, what is being done, and of course, what are the opportunities as companies figure out ways to solve this problem. Stay with us. Welcome back. We're talking about perhaps what's going to be talked about quite a bit more over the coming years, which is the water crisis, right? Now, companies, of course, lots of companies are dedicating themselves to solve for the problem through various ways. The government of India, of course, has been sort of involved quite heavily now over the last couple of years as compared to any time in the past. So let's actually dive into this topic in some detail. We have Rajiv Mittal, Managing Director, CEO at VA Tech Vibhag. We also have Vinayak Chatterjee, Founder and Managing Trustee, the InfraVision Foundation. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mittal, let me start by sort of taking the first question to you. At VA Tech, from what I understand, you are betting big on you're betting big on taking desalination, right? That's essentially the big bet that you're making at this point in time.
That's right.
How is this different as compared to what you did 10 years back? Because I remember back in 2013, 2014, there was a lot of excitement around your company, around what the potential is, because the problem was well understood even back then. And then, of course, things kind of did not go as planned. Investors especially are making a big bet on you and the theme once again. So what has changed in the intervening 10-year period, Mr. Mittal, if we can start by asking you that?
Prashant, good morning, and good morning to your viewers. Vinayak, also good morning to you. Nice to see you here. See, I think the question is relevant today, and it was relevant 10 years back, and I'm sure it will be relevant 10 years from now. The things what has changed is in last 10 years, there's more awareness on this topic. Even if you see our first desal plant in Chennai for municipal corporation was way back in 2010. Which we completed and commissioned in 2013. So this is not new, and Chennai gives us the opportunity. Even recently, Chennai has placed Asia's largest order, which was JICA funded, 400 MLD, 4 times bigger than what they had built about 13 years back. So I think we have to realize that water, fresh water, is a limited resource. And where do you get it? You are so much dependent on weather, and with all the climate change happening, the rainwater is becoming highly unpredictable. And we can't develop our economies, we cannot develop infrastructure, communities need water. And with our standard of living going up, our consumption of water patterns have gone up. The only reliable source we have to look at, which are the perennial source. 97% of the water on earth is in seawater. And it will be, I think, sad if we don't tap that seawater, which is a perennial source, reliable source, drought-proof source. And today, it's also affordable.
So, Mr. Mittal, that's what my point is. Is it affordable now? Is it vastly more affordable, these plants, as compared to what they were 10 years back?
See, if you talk about affordability, 10 years back also it was affordable. The prices have come down with the technologies moving up. The power consumption has come down. The power cost has come down. The quality of products have improved.
The cost of running these plants has come off quite a bit. Got that. Mr. Mittal, I'll just come to you. Let me get Vinayak into the conversation as well. Mr. Chatterjee, talk to us about, is desal, as Rajiv put it, Mr. Mittal put it, the accepted solution now as far as this solving for this problem is concerned? Water?
Well, it is one of the solutions. So, but to answer your question, I will need to step back a little and talk about 4 buckets of solutions. The 4 buckets, one is geographical interventions. Second is policy interventions. Third is micro-level interventions. And the 4th is technical and technology-related interventions. So if you just give me a few minutes, I will just bullet point some of the key issues in each of these buckets. Let's take bucket 1, which is the geographic solution. And I'm looking at India, the country and the economy as a whole. Remember, we have had developments like the Rajasthan Canal, which has seen the greening of the desert from North India, Northwest India, right up to Gujarat. We have seen the commencement of river linking projects very recently with the Ken-Betwa river linking. These are major interventions to take water into arid areas and impact livelihoods. Second, in the past, India has been a leader in multi-purpose hydro and dam projects. Think of the Damodar Valley project, which conserved water by controlling floods. You actually harvested and stored water, which otherwise would have led to the flooding, useless flooding of a large portions of Bihar and Northwest West Bengal. So these are examples of geographic interventions on water conservation, water management at a country level. Then very recently, 3 months ago, very interestingly, since India's independence, the first ever census of water bodies was published. That has turned the spotlight on how we, first of all, do we know how many water bodies there are in rural and urban India, and what do we do about them? Because as you know, water bodies are a very severely neglected source of water supply to communities. And finally, in many rural areas, there is the whole movement of check dams. Now, all of these relate to geographic interventions to address the water shortage issue. Come to policy. Policy, the biggest dampener on policy on water sector is the free power given to agriculture, because farmers use it randomly, wantonly, and it is documented that it has led to the reduction of water tables across large portions, certainly of Punjab and northern India. Then there is the issue of urban planning. How seriously do our town planners pass plans for townships, industrial complexes that choke water bodies as well as channels? And the floods in Madras are a testimony to lack of discipline and oversight by urban town planners and town managers. These are policy level interventions. Come to micro.
Mr. Chatterjee, let me just get Mr. Mittal into this conversation as well, right? About all the policy interventions that are happening at the moment. Mr. Mittal, you know, by 2030, the water demand in India is projected to be twice as much as the supply. And that's quite concerning. Do you think enough processes are put in place, both on the private and the public sector end, to set up these comprehensive water, wastewater treatment facilities? And what more do you think needs to be done?
I think, Sonia, it's very clear. We as water managers, that is our job, to get these challenges. What you mentioned, the demand is far exceeds what supply is. And that's where we come in. We come in, what we call it, into a manufactured water. We just don't depend on the natural water which we get as a God's gift by rains or from glaciers. This is hardly any water. If what you just now said was on desalination, that is one solution, at least for all the coastal cities. India is a vast coastline, about 7,500 kilometers. Why can't we set desalination plants when Chennai has demonstrated this viability, economic it is, and is affordable and it's reliable because it's drought proof. The second one which I would like to emphasize, which is even more affordable, is recycle of water. We have to realize water is a limited resource. We just cannot abuse water. We have to conserve water. Why we are not recycling water when globally this is well accepted? And at least you start for the industries and agriculture, which consumes almost 98-99% of our water. You talk about supply, and just hardly 2-3% goes to a domestic consumer. For domestic consumer, we can use desalination water. For all other, we can use recycle. And that is also infinite resource. It's a drought-proof resource. It's also reliable, affordable. So my short answer, Sonia, to you, yes, we have solutions and we can build a water secure, not only India, but the whole world. We can build a water secure in terms of water availability.
Mr. Mittal, you know, if I can sort of ask you to distill from the macros to the micros with regards to your company, because I mean, a lot of the audiences will also be investors in your company. Could you tell us what is the order book at Viatec Vabag right now? What do you expect it to? Yeah, sorry, go on.
See, it's more than 12,000 crores. Okay. And a substantial part, what we are discussing today, is desal and water reuse.
Got it. What's the visibility in terms of order pipeline from here?
I think we are very bullish about water. You know, we are a pure play water company. Other than water, we don't do anything. If you even see globally, water is a big topic and India is second to none. There's a huge opportunity. So we will not be short of opportunities in terms of water.
What percentage of your order book comes from municipalities, local organizations? Because, I mean, you know, that was where back, I mean, I think 8-10 years ago, receivables, etc., had become a bit of a problem. Could you tell us if that has kind of moved away in quite a significant way now, Mr. Mittal?
Yes, it has. I think, Prashant, you have seen yourself that if you see last 3-4 years, we have been always cash positive. So those days are gone. There was a shift of strategy. Our selection of projects was all about the payment security. If you see, 98% of our order book is today based on multilaterally funded projects, central government funded where we have a sovereign guarantee, and for international projects, we have a letter of credit. So those days are gone. I think if you see in the last 4 years, I think we are back on cash positive. We generate free cash, and this is the way we want to grow in future also.
Mr. Mittal, you had put out a number. Actually, the reported number is about revenues are about 3,000 crores last year. That is FY23. We'll get the numbers for this year shortly. Once again, going back 10 years, you had put out a revenue target back then of €1 billion, right? Is that still kind of the aspirational number? I mean, and is the road looking a little more firm now? I mean,
yeah, it is. See, it is always firm. When you drive on the road, you don't know. Sometimes the speed breakers may come or potholes may come. This was like COVID potholes coming, which has taken the whole thing 3 years back. But our targets are firm, and we don't have a year when we want to achieve it. So we want to do it earlier than later, but we also have to be aware of all the geopolitical challenges which are there in the thing. We want to reach our target in a healthy way, rather than reach a target and then we say, why did we reach? So we are aware of our target and we are moving towards it, and the opportunities are immense.
All the best for that. But Mr. Mittal, one final question. In terms of FY25, FY26, what kind of average revenue growth are you looking at? And will it be disproportionately higher to what you've seen in the recent past, purely because how demand-supply dynamics are playing out?
See, Sonia, we have always looked at 15-20% CAGR growth, but you should also be aware, because of strategy, some of our stagnant European subsidiaries we have divested. So those